Good morning and welcome to Financial Accounting. This is day 13 of 30 for the fall 2022 semester. Today, we are going to be finishing up chapter 6, and that means that we will be ready for our second exam. I did finally find a time that I could schedule the review session for this exam. So the review session will be tomorrow afternoon from 3 to 4. I apologize for the late notice. Hopefully some of you can join us. If you'd like to join, please sign up in Starfish so that I know you're coming. And that's how you get the link to join the session as well. If there's anyone there, I will record the session. If nobody is able to attend live, of course, there won't be a review session. And so there won't be anything to record. But if we do have a session, then I will record it and post that recording as I do with all of our class time. My expectation is that we would cover the practice set, some or all of the practice set for the exam. If you are planning to attend and have something else be outside that practice set that you want to cover, I would ask that you send me an email and just let me know. I'd really like to talk about this so that I can prepare if needed, picking out any extra exercises or whatever. So tomorrow, Wednesday, October 5th from 3 to 4, we will have a review session if there's anyone who's able to attend. I was trying to have that tomorrow morning, but it was just not going to fit in around my other scheduled activities. Problem, thank you. Okay, so review session tomorrow. We'll finish chapter 6 today. I need to correct myself from last week. I had thought 6-week grades were due yesterday. They're actually due tomorrow. So yesterday was the end of 6 weeks. But I just had it wrong. I had it right in my calendar. I had it wrong in my head. So what I had said last week about checking your 6-week grades after yesterday, now you'll need to wait until Thursday for that. If there aren't any questions or anything, we will just move on to our new material. Any questions from what we did last time? We covered the perpetual inventory system, where we update our inventory records every time we have an event or a transaction that affects our inventory. So if we buy more inventory, we add it to the inventory. If we sell inventory, we remove it from the inventory. If we accept a return that we're putting back into stock, then we and record that in our inventory as well. So what we're going to be doing first today, there were 3 exercises, exercise 4, 5, and 6, that were review of what we had done in class. I had asked you to complete those on your own, and I just wanted to show you the results. So I had prepared an Excel template. This template, without the dollar values in there, this template, there's not much to it, but I just wanted a way of organizing the final results from those exercises so that we could do a quick comparison. So this again is exercises 4, 5, and 6. It was using the same data and using all 3 of the methods that we learned last class: LIFO, FIFO, and average cost. So the weighted average cost was exercise 4, FIFO was 5, and LIFO was 6. These are the final numbers from those exercises. And so what I wanted you to see, when we had all of the same data, same company, what would it look like if they used each one of the 3 methods, is keep in mind for those exercises, we were in a period of rising prices. So the price of the product we're selling increased throughout the period, throughout the month or the year in question. And so what you see is that for ending inventory, FIFO has the lowest. Do I have those backwards? Hang on one second. Should have looked more closely. Okay, enter those into the spreadsheet backward. So give me 1 second here. I need to just confirm those. So LIFO was 162. So let's go over here. So apologies for that. I just copied the numbers out of my exercises this morning, but I must have put them in the wrong cells. And the reason I knew that was because what I was about to say wasn't correct. So in a period of rising prices, FIFO has the highest ending inventory and the lowest cost of goods sold. But LIFO has the lowest ending inventory and the highest cost of goods sold. And the weighted average cost method is somewhere in the middle. And so it's kind of the average of the two. How do we know that that's correct? Well, in FIFO, first in, first out, the assumption is that we sell the oldest stuff. And so the oldest stuff in a period of rising prices is the lowest cost and therefore has the lowest cost of goods sold. First in, first out, meaning that we sell the oldest stuff, also means therefore that we keep the newest stuff, and in a period of rising prices that would have the highest cost per unit and therefore the highest ending inventory value. We kept the more expensive stuff in our ending inventory. And so the ending inventory for FIFO is higher than either of the other two methods. I'm not going to insult your intelligence by walking you through that same conversation with LIFO, but I hope that you can do that in your head. So this isn't a period of rising prices. In a period of falling prices, the opposite of what I just said would be true. And if prices are volatile, that is, they're going up and down unpredictably, there's no one direction to their change in price, if you will, then we can't make any kind of blanket statement like this. So what impact does this have on their financial statements? Which one, keep in mind, in these three exercises, it was the same company doing exactly the same thing, but they're reporting information a little bit differently because of the assumption they make about the flow of goods, the flow of costs through their accounting inventory records. So same company, same activities, but it gets reported somewhat differently. So which one of these three methods in a period of rising prices, which one of these three methods makes the company look better on their financial statements? Is it better to have a higher inventory or a lower inventory? Higher. Higher makes them look like they have more assets. Again, you can walk through that. Ending inventory belongs on the balance sheet as a current asset. So if our ending inventory is higher than our current assets, and therefore our total assets are higher, and that makes the company look better. On the income statement, would we rather have more expenses or fewer expenses? Which one makes us look better? Do we look better if we have more expense? No, that lowers our income, right? So again, looking at these cost of goods sold, which one makes our income higher? FIFO. In a period of rising prices, FIFO gives us a higher ending inventory and a lower cost of goods sold. Therefore, the gross margin, gross profit is higher, and the operating income and then the net income is higher. So why wouldn't everyone just use FIFO? Well, for one thing, prices aren't always rising. For another thing, there's really no cash flow difference. If you look at the information that was given in those three exercises, the cash flows remain exactly the same, except for one tiny thing that I'll explain in a second. So cash flows remain exactly the same. What they charge their customers is the same. What they paid their suppliers is the same. The difference is which costs we say went out the door and which costs we say were kept. But as far as the amount we actually receive from our customers, pay to our suppliers, it's exactly the same. with one small exception. And it may not be that small. The only cash flow difference among these three methods is the income tax the company has to pay. So if you report a higher income, you are going to pay a higher tax, right? Everybody gets that, yes? Report a higher income, you're going to pay a higher tax. So there is an incentive for the company. If that's the only cash flow difference, there's an incentive for the company to use the one that minimizes their tax burden, which would be the one that has the highest cost of goods sold, which would be LIFO in a period of rising prices. Higher expense, lower income tax. So there's an incentive for companies to use the LIFO method, at least for tax reporting. So I've mentioned a couple times before, and it will come up again later in the semester, that what we are learning in this class is financial accounting. This is to put together our financial statements and our annual report to share with the public. Tax accounting is a little bit different, in some cases a lot different. So what we're allowed to do for financial reporting might be different for tax reporting. And that's fine. Kind of, it means that companies are keeping two sets of books. But there's nothing, they're not trying to hide anything. It's not, an attempt at fraud. It's just different sets of rules for different purposes. For the most part, the IRS, the tax regulations disregard financial accounting rules, okay? For the most part, it's kind of live and let live. You do your thing for financial accounting. We'll do our thing for tax reporting. No problem. This is one area where the IRS does get involved though, and they actually say, if you use LIFO on your taxes, and we had just went through why companies would do that because it lowers their tax burden. If you use LIFO for tax purposes, you must use LIFO for your financial accounting records as well. You can't have your cake and eat it too. You can't use LIFO to save money on your taxes, but then use FIFO on your financial accounting reports because it makes you look better. Okay. Before we start our new material for today, which is using the periodic system, does anyone have any questions as we wrap up the perpetual system part of the chapter? Okay, we will keep going then. Let me get back to so our first exercise for today is going to be exercise 7. So if you do not have your Cengage exercises open yet, now would be the time to do that. And we get to here. Okay, so exercise 7 deals with the periodic inventory system and all 3 methods. So you'll notice this is a lot more straightforward, a lot easier to calculate and to report than is the perpetual system. So why did we spend literally all class last time, plus those exercises you did outside of class, talking about the perpetual system? Well, one, because that is the most commonly used system now because of the increased availability and the lower cost, the affordability of computerized accounting information systems to manage our inventory on a perpetual basis. The perpetual system, as we were looking at it in those first 6 exercises, though, is very tedious because we have to record every single transaction. Remember, we were only looking at companies that sell one product, which is, pretty much not existent, right? Virtually every company that sells a product sells more than one product, maybe tens of thousands of products. And so The perpetual system, if we had to do it manually or by hand, like we were doing in those exercises, is pretty cumbersome. But I needed you to see what was happening, what the computer's doing in the background, because that is the most common approach in 2022. The periodic system means that we only update the inventory periodically. And so last class, as we looked at the perpetual system, I stressed that we have to do things in chronological order. We have to keep those layers of inventory in order from oldest to newest, so that we know, when we use LIFO or FIFO, so that we know which ones to sell and which ones to say we kept. For perpetual system, we don't update it except just once each period. And for this exercise, we're going to be looking at this. We're standing at the end of the year. We're at December 31st. We don't have to keep in mind the order in which purchases happened. We don't need to know where the sales happened in terms of the relationship. We assume that whatever we had available during the year was available every time we had a sale. Now, clearly that can't be true. If we had a sale on, looking at these data, if we had a sale on January 15th, the only inventory we had available at that point was the $4 inventory. But under the periodic system, we don't care. Doesn't matter, as it did in the perpetual system. And so let's do some quick math here. Using the information we have available here, the units of an item available for sale during the year were as follows. And we're told that we had some beginning inventory of 5,500 units. And we bought 6,400 more units, then 6,000, then 2,100. And so the total units we had available during the year was 20,000. The total units we had available was 20,000. It tells us then at the end of the year, there were 1,500 units left in the physical inventory. So they went out and counted it. We talked about physical inventory last week. They went out and counted the inventory and determined they had 1,500 units left. So how many units did they sell? Sales. So the sales were 18,500 units. Now, thinking back to something I told you last week, we don't know for sure that they had reported revenues for 18,500 units. What we know for sure is that 18,500 units are missing. We assume they were sold. And so the cost of those units, whether they were actually sold or not, some of them may have been, I'm going to say gone missing as a result of inventory shrinkage. Again, we talked about that concept last week. So it may be that we gave some away. It may be that some spoiled or got damaged and we just threw them out. Either way, we don't have them anymore. And so they become part of the cost of goods sold. So what we're looking at here, we're using, again, the periodic inventory system, and under each one of the three approaches, the three methods, we're asked to determine the inventory cost. They mean the ending inventory. They mean the cost of these 1,500 units that were left as of December 31st. Okay. So if we use the FIFO method for letter A, first in, first out, we know we have 1,500 units, but the question is, what's the value of those 1,500 units? The number of units does not change just because we use a different method or a different system. Under the perpetual and the periodic system, and LIFO, FIFO, and average cost, or even specific identification that I talked about last week, where we actually identify exactly which unit we sold. We don't make an assumption about the flow of costs. The units does not change. How many units we have is based on the physical inventory. Someone went out and counted them. We have 1,500 units. The question simply is, how much are those units worth? And that decision is based on the assumption we make about the flow of costs. First in, first out. The oldest units are the ones that we sold first, and we keep the newest units. So under FIFO, the 1,500 units in our ending inventory will be the 1,500 newest units we have. So what would be the cost for those units? Yeah, sorry. What's the unit cost for those units? Whoever just said that said the right answer, but I'm looking for it. How much is each one of those 1,500 units worth? Thank you, $10. That's from the November 23rd purchase. $10. So 15, and that's going to be the answer for your box there. I can't do that yet until I turn off my recording here, my text writing, screen writing. So 1,500 units at $10, a total of $15,000. I will tell you that even if we used a perpetual system, that answer would still be the same. That is not true for LIFO. It is not true for average cost or weighted average cost, but under the FIFO method, you get the same result, the same answer, if you will, whether we use a perpetual or periodic system. But now we're moving on to LIFO. And under the LIFO method, last in, first out, the assumption is that we sell the newest units and we therefore keep the oldest units. So under LIFO, those units would be worth how much each? $4. Now keep in mind, we had to have 1,500 units at $4. If our opening inventory was only 1,000 units, we would keep all of those 1,000 units at $4, but then we'd have to bump to the next oldest, the $6 units, to finish up that inventory. So we'd have 500 more units at $6. But because we did have at least 1,500 units in our beginning inventory, we can keep all of those. And so for 1,500 units at $4 would be $6,000. The weighted average cost is going to take just a little bit more work for us because we don't have the total value of that beginning inventory of the inventory beginning plus the purchases. So I'm going to have to do that first. So let me just get my. So I have to, we know that there were 20,000 units, but we don't know the total value of those. So I need to do a little bit of math here. So 5,500 units at $4. The beginning inventory had a total value of 22,000. We're going to add to that the 6,400 units at $6. Or 38,400, then the 6,000 units at $8. And then finally, the last purchase of November, 2,100 units at $10. So now I just need to add those all together. And I got 129,400. Anyone else do that and get that same number? So that $129,400 is the total value of all 20,000 units that we had available during the period, during the year. We use the same formula to calculate the weighted average cost. Remember, I showed you last class where those formulas are in the reference materials folder in Blackboard in the chapter 6 folder in the reference materials area. And the formula for finding that weighted average cost is the total value divided by the total units. And that will give us the cost per unit on average throughout the year. And it tells us to round that to 2 decimal places. I think it actually does already work out to 2 decimal places. So I got a value of $6.47 per unit. As I pointed out last class, when we did the weighted average cost method, did we actually buy any units that cost $6.47? No, we paid 4, 6, 8, and 10. But as far as we're concerned, we paid $6.47. As far as our accounting records are concerned for this year, $6.47 was the cost for each unit. And so if our ending inventory had 1,500 units in it, 1,500 times $6.47 is $97.05. And so this exercise, because of the extreme price changes, the price went up 2.5 times during the year, from 4 to 6 to 8 and then to 10. That's a very, very extreme price increase during the year. Because of that steep price increase, we see the dramatic difference between the among the 3 methods. Again, in a period of rising prices, we see that FIFO has the highest ending inventory, LIFO has the lowest, and weighted average is somewhere in the middle. But we see it much more pronounced here. The older a company is, the more pronounced difference you would see as well. Because it's reasonable to assume that prices are going to increase more in a 20-year period than they do in a 1-year period. So any questions about using the periodic inventory method under all 3 systems? It is much easier to calculate. If we had been asked to calculate the cost of goods sold, that also would be much simpler, because we know that we had, and just mark this here. We know that we had available $129,400 worth of inventory. By subtracting the ending inventory from that number, we would find the cost of goods sold under each one of the 3 methods. That calculation or relationship formula is also in the reference materials folder for chapter 6 in Brightspace. Showed you that last time. You may want to keep that in mind. Maybe if you have a notebook, either print it out and stick it in there, or if you have just like a spiral bound notebook, not a binder, maybe copy those formulas into your notebook so that you have them for easy access for reference. Questions, anybody? So much simpler than what we did in the perpetual system, where we were constantly updating our inventory and recalculating weighted average cost, or listing all of our ending inventory layers, both in FIFO and in LIFO. This is much simpler, but we talked about some of the disadvantages of the periodic inventory system, which is when we look at our accounting records, we don't see How much do we have available? We don't have that instant access. The only time we know for sure how much inventory we have is when we go out and physically count it. Okay. If there aren't any questions, we will keep going. And we're going to talk next about, give me 1 second here to get to the right slide. So our next exercise is showing us a little bit different approach to reporting inventory. So the first 7 exercises for this chapter focused on calculating the cost of that inventory. It was based on how much we actually spent when we bought that inventory. We still had to make an assumption about which of those units we sold using LIFO, FIFO, or average cost. We also had to know whether we're using a perpetual or periodic inventory system to know how to do that. What we're about to talk about does not replace having to do what we just did. Okay. The concept that you see, or that we're going to talk about in this next exercise, is an alternative. We still have to maintain our inventory records. We still use either a perpetual or periodic system. We still make a choice of the method, LIFO, FIFO, or average cost. But this adds an extra step at the end. Excuse me. And the extra step is, once we have that cost established, we compare that to the market value. And by market value, we mean how much would we get if we sold it? What's the current selling price? And so, excuse me, in exercise 8, we are going to look at an example of using this LCM, lower of cost or market. The idea is, if the market has vanished, dried up for the product we're selling, what's going to happen? This is basic economics. If people aren't buying what you want to sell at a certain price, what do you have to do to get them to buy it? You have to lower the cost, lower the price, right? So that's the basic law of demand, tells us that. People aren't willing to buy what we have at the current price. We have to lower the price, put it on sale, discount it. And so the idea of the lower of cost or market inventory valuation is, if we can't sell it for even how much it cost us to buy it for whatever reason, maybe the product is obsolete, maybe tastes have changed and people just don't want to buy it. This time of year, people are discounting or clearancing summer stuff, and because people, they don't want to hold on to it till next year and hope it's still in fashion, or hope it's still good, it doesn't spoil or get lost. They don't have to pay the storage cost of keeping it around till next summer. And so they might agree, they might decide to lower the price even below what they paid to acquire it, because they'd rather get something out of it than nothing. And so, excuse me. And so with the lower of cost or market, we still have to find the cost using one of the 2 systems and one of the 3 methods that we've already discussed. Then, once we have that cost, we compare it to, well, what can we get for it if we sell it? And they're going to report whichever is lower. The reason that we do that, the reason we do that comparison at all, is the accounting principle known as conservatism. This is not like political conservatism. In accounting, when we say we want to be conservative, what we mean is we don't want to mislead someone, a decision maker, using our accounting records. We don't want them to think that our company is in a better position than we actually are. And so it applies in 2 ways. One, we don't want to overstate our income. If we have to make a choice, We don't want to overstate our income. So we're going to err on the side of understating our income if we're not sure. And when we look at the balance sheet, we don't want to overstate our assets and therefore our equity. And so the whole reason we do this comparison after, add this extra step, add this additional layer of work we have to do as accountants, is not just to keep people busy, it's to make sure that we are not overstating the financial position of our company. And so if we can't even get from the product when we sell it, if we can't even get back what we paid for it, we would want to write down or lower the value of the inventory on our balance sheet. And that's exactly what we're going to be doing in exercise 8, exercise 8. So let's go look at that now. In exercise 8, we are going to be looking at this in 3 different ways. So this is a company that sells 5 products, model A, B, C, D, and E. And for each one of these, we are given the cost, that's how much we had to pay for it, that's going to be based on using a perpetual or periodic system, using LIFO, FIFO, or average cost. For this exercise, they don't even tell us which of those choices the company is making, what system, what method they're using, but it's based on one of those. And we already have the established cost here. Looking at just at model A, we have the established cost of $120 that would be based on which system and method they're using. But then we look at what's that product selling for now? What do we expect to get back from it after we sell it? What revenues minus any additional cost associated with selling it? What do we expect to get back? The net realizable value. And so just for model A, as an example, it's a little bit misleading. It definitely violates the accounting concept of conservatism for us to carry that inventory on our books worth $120 if we know we can't sell it for more than $105. Does that make sense? It's a little misleading to carry that at 120 if we know we can only sell it for 105. And so the company's going to make a decision to carry it at the lower of those 2 values, the 120, which is the cost, or the 105. Now, what we're going to see in parts A, B, and C are different ways of looking at that. What 2 numbers are we comparing when we say cost and market? You can see that they have these 5 products that they sell divided into 2 classes. Excuse me. And so just quickly before we start with the actual work of the exercise, there are 3 different ways we can easily look at this. We can look at our inventory as a whole and calculate the total value of the inventory at cost and at market and choose the lower one. We can look at it class by class. So we look at the total for class 1, cost and market, which one's lower, that's the one we use. Then we do the same thing for class 2. Or we could look at it line by line. We could look at it for each product. The most conservative approach is to look at each product individually and state each product at the lower of cost or market. That's more complicated, takes more work on our behalf, because in this case, we're making 5 decisions. Which one do we use? Rather than 2 decisions if we go by class, or 1 decision if we look at just the inventory as a whole. But that's what we're going to be doing in each of these 3, letter A, B, and C. We're going to look at first each item in letter A. Then we're going to make a decision based on the classes. Then finally, we're going to end with the inventory as a whole, the least conservative. Still more conservative than not using lower of cost or market at all. But it's going to smooth out some of those highs and lows. If we have some items that the cost is higher and some items that the inventory, the net realizable value is higher. So for each one of these, for the first column of inventory quantity, we are simply pulling in the information given in the table at the top, inventory quantity. So go ahead and enter those. And the next column is the cost per unit, also given. And the column right after that is the market value per unit. And so the first three columns, we are just bringing in the information that was given in the top table. Is that big enough to see? There, how's that? So those numbers, those values that I've filled in so far is just the information that was given. For the next two columns, we are doing what I called last class, the extension. So we are multiplying the units times the cost per unit. So for model A, $420. Sorry, excuse me, and God bless you. 420 units at $120 each. Total value of $50,400 at cost. Same 420 units if we value them at the net realizable value of 105 per unit, 44,100. I'm going to pause the recording here and ask you to just fill in the cost, total cost and total market value for the next 4 units. And then you can go ahead and add down the column too to get the total at the bottom. I'm going to pause the recording, go ahead and complete those and then restart the recording. Okay, so I've filled in the rest of the table. And for letter A, as I said, we are applying the decision of lower of cost or market to each item that we sell. And as I said, this is the most conservative of the two approaches. So as we look at model A, the lower of cost or market is which one? Which one's lower, cost or market total? The market. So I'm going to fill in the value of the market price. How about for model B? Which one is lower, cost or market? Cost. I'm going to pull in the total from the cost column. How about model C? Which one's lower? Market. Model D, market again. And model E, cost. And so if I just add down that column now, $246,700 is the, if I add it right, 246,700 is going to be the amount that this company would show on their balance sheet as the value of their ending inventory at the end of this period. The other two approaches, as you'll see, are going to end up with a higher ending inventory than this, because there's no, we have chosen at the lowest possible level, the lower of cost or market. It can't possibly go any lower than that with the data that we have. So hopefully you can see why that's the most conservative approach. I'm not saying it's the right one. Companies may justify their choice. There isn't a wrong answer except to the extent that whatever we put in our financial statements needs to actually represent reality to the people using those financial statements to make decisions. They need to be a faithful representation of what's happening inside the company. So what I want you to do next, and again, I'm going to pause the recording to allow you to do this. the information from the first 5 columns is going to be exactly the same from A to B. The only thing that's going to be different is this, the 2 subtotal lines here. So please go ahead and pull in all of the same information from part A into part B, these first 5 columns, except the subtotal lines. You'll have to calculate those anew. Okay, so I brought down all the information from part A into part B. I added in the subtotals, which is just the total of each class. And we are now making that decision of lower of cost or market by comparing the class totals rather than product by product. And so for class 1, which one is lower, the cost or the market? For class 1, which is lower, the cost or the market? The cost. So when we looked at product by product, we pulled one value from the market, one value from cost, third value from the market. But in this case, we look at the entire class and we take just the cost. And so that includes the cost for model A, where the market value was lower. It also includes the cost for model C, where the market value was lower. And so we end up including a couple model by model prices that are the higher of the 2 values. We'll do the same thing for class 2. Which one is higher, the cost or the market? Which one is higher? So cost is higher, so we're going to use the market. I said that kind of backward there. So the cost is higher, we're going to use the lower, which is the market value. And so for this company, if they chose to use the class by class comparison, which was easier in the long run when we're doing it by hand, because we had to look at just 2 comparisons rather than 5. So we end up with an ending inventory value of 258. Still lower than either the cost or the market, but if you just scroll up a little bit, it is higher than the value that we used when we compared individually product by product. In the interest of time, I'm not going to individually transfer these data into part C. You will want to do that to get credit for part C, but I'm just going to use the information we have here in part A, and you're going to copy, just like we did for B, copy all of the information, but rather than making a product by product or even class by class comparison, in part C, we're only comparing the totals. And so we're comparing this number for cost of 262 to the market value of about 267. And so which one of those would we use in part C? Bring that in so you can see it. So we have the 262,450 and the 266,660. Which one of those totals is lower? The cost. And so we would use the cost. We feel better about it because we did the comparison. And we said, yes, the market value is not lower. And so we're still going to stick with cost. As I said, any one of these 3 approaches for this particular company is perfectly fine and acceptable. They would have to make a decision about which one is the most reasonable to use to faithfully represent what's happening inside our business, so that decision makers outside the business relying on these data have the best information to make the decision. Now, for most companies, they're not going to need to use this lower of cost or market approach for most of their products, because it's obviously a rare, somewhat rare circumstance that they paid more for the product than they can get by selling it. So they may choose to only do the comparison, only find those data and do the research when there's a question about the actual value. So maybe these are products that have been discontinued or products that have been replaced by a newer model. And so obviously that then lowers the value of the outdated model. Okay, so they may only do that comparison for certain products or certain types of products. And that's fine. Any questions about the lower of cost or market approach? So an important step for some companies, but not necessarily for all companies or for all products. The idea is just to make sure that the information that we are sharing with the public, sharing with decision makers, allows them to make, let's say, a valid decision. Moving on then to our next exercise. Our next exercise then deals with, what if we make a mistake? What if we make a mistake? So keep in mind that all companies, regardless of whether they use a perpetual or a periodic system, all companies need to take a physical inventory at least on an annual basis. And for companies that are going to undergo an audit, so all publicly traded companies, are then going to have that inventory audited as part of their natural audit process. So somebody is checking to make sure that the inventory that they say they counted actually exists. But mistakes happen. We have real live people counting the inventory, and it's possible for a variety of reasons that there might be an error. There might be an error in counting the product. Maybe they double counted something because they had two different people assigned to the same area. Maybe they totally missed a whole section of inventory. Maybe there was some inventory in their warehouse and it was covered with a tarp or something, and or somebody thought Joe counted it and somebody thought Sue counted it. That can happen, an actual error in the physical inventory. It also could be, based on what we've been talking about so far in this chapter, that the value they assigned to it was not the correct value, that they used the wrong approach, they had the dates wrong or mixed up. And so as we've been talking how important it is to keep things in chronological order, maybe there was an error in that way. Maybe there was an error in calculating if they're using weighted average. It could be that some inventory didn't get counted because it wasn't physically on location. So we talked about where does title change hands? Who owns the inventory while it's in transit? Maybe there was inventory in transit that didn't get counted correctly. Either it was included when it shouldn't have been because we'd already sold it and recorded the revenues, or because we didn't include it when it should have been included. We already bought it from the supplier, but because it hasn't reached us yet, we didn't count it, and therefore it didn't get included in our ending inventory. Or inventory could be sitting in a different selling location, like consignment of inventory. And so we still own it. We just have someone else trying to sell it on our behalf, and we, for whatever reason, it didn't get included as it should have been. So any one of those things can happen. And when that happens, we will end up with mistakes on both our balance sheet and on the income statement. I'm not going to walk through every item on this exhibit, but this exhibit is in your book, and I would encourage you to take a look at it if it helps you. We're going to do a very similar exercise in exercise 9 on our own. But keep in mind the relationship that we talked about in exercise 7 today. If we know how much inventory we had at the beginning of the year, and we know how much we added to it through purchases, we then know how much we had available for sale. And at the end of the year, there are two choices. Either we still had it and it's in our ending inventory, or we believe we sold it and it becomes part of cost of goods sold. Knowing that, if we think we still have it, but we don't, not only is our ending inventory wrong, the cost of goods sold is wrong. If we say we still have it, our inventory is too high and our cost of goods sold is too low. The other situation, we think we sold it. We forgot to count it. We miscounted and we understated our inventory. If we don't think we still have it, what do we think happened to it? We think we sold it and it becomes part of cost of goods sold. So if we understate our inventory, we've overstated cost of goods sold and therefore understated our income. Either one of those situations is bad from an accounting standpoint because you're providing misleading, incorrect information to decision makers. And so it's a serious error if it's material, if it's a large enough number that it would lead a decision maker to make a faulty decision about our company because it's big enough, it's material. That becomes a very serious issue, for lack of a better term, with our financial statements. So let's go to, let's go to our next exercise. By the way, there is another, so the first one I just showed you was what if we overstate the inventory? There's another part to this exhibit, what if we understated it? But again, we're going to walk through those scenarios, talk through each one of them in our exercise. So let's go to that. Excuse me. Exercise 9 says, Madison River Supply Company sells canoes, kayaks, whitewater rafts, and other boating supplies. During the taking of its physical inventory on December 31st, 2008, Madison incorrectly counted its inventory as 678,000 instead of the correct amount of 687,000. They understated it by $9,000. That's the answer to our first question. What does this do to our inventory on our balance sheet? We wrote it as 678, should be 687. It's understated by $9,000, the difference between those two numbers. Everyone agree with that? Okay. Understated by 9,000. If our inventory is understated and the inventory is part of our current assets will end up being understated by the same amount. And that means our total assets are also understated by the same amount. Remember the fundamental accounting equation, assets equals liabilities plus equity. If we've understated the asset side of our balance sheet, we must also have understated the liabilities and equity part, or they wouldn't balance. Well, there's nothing here having to do with our liabilities, and so it would be our equity on the credit side of the balance sheet, as I like to call it. The equity would also be understated by 9,000. Why would that happen? What would the mechanism be to make that happen? Well, remember, if we think it's not in our ending inventory, what do we think happened to it? We believe we sold it. It becomes part of cost of goods sold. It then lowers our net income by $9,000 and lowers our retained earnings by $9,000 when we close our books, and retained earnings, of course, is part of equity. And that's where it would show up in the equity section. Our retained earnings would be 9,000 too low. And that leads us into the second part of this exercise. So what happens on the income statement? If we don't think we have it at the end of the year, we think we sold it and we include it in our cost of goods sold. So we overstate our cost of goods sold by $9,000. We knew we had it. We don't have it anymore. Must be we sold it. If it's included in our cost of goods sold, it then gets subtracted in calculating our gross profit or gross margin. Our gross margin would be $9,000 too low, making then our net income also $9,000 too low. Make sense so far? So not only does it affect the income statement, the balance sheet, excuse me, it also affects the income statement. So now let's think what would happen. So now at the end of the year, we included $678,000 on our balance sheet as the inventory. We're missing that $9,000. At the end of 2019, when we recount our inventory, we'll assume that we counted it correctly this time. And so on our balance sheet at the end of 2019, our inventory is correctly stated. But what happens to our cost of goods sold? We actually have that $9,000 worth of stuff and we sold it this year. But we didn't know that. We actually recorded it as sold last year. And so this year, we would be understating our cost of goods sold by $9,000 because we thought we sold it last year. We were wrong. We thought we sold it last year. And so we missed that. Remember how we calculate our cost of goods sold is goods available for sale. Goods available for sale is $9,000 too low because our beginning inventory was $9,000 too low. So the cost of goods sold ends up being $9,000 too low. Therefore, our gross profit is overstated and our net income overstated. If you look at this, comparing B and C, what's on the screen right now, kind of cancels itself out, right? Too high one year, too low the other year. Now, in total, it's exactly what it should have been. And yes, the inventory at the end of the second year is now correct. So what does it matter if we had it too high one year and too low the next year? Well, one thing, it makes our company look more volatile than it should. It can lead a decision maker to make a faulty, misled decision about our company because they're not looking at the combined results of the 2 years. They're looking at what happened in 18, what happened in 19. 19 makes them look a lot better. The swing is $18,000. So 2019 looks like they did $18,000 better on their income statement than in 2018. All else equal. Definitely could lead them to a faulty decision. For letter D then, if uncorrected, what would be the effects of the error on the 2019 balance sheet? And I already said the balance sheet would be correct at the end of 2019 because assuming they count it correctly at the end of 2019, that's what's going to show on their balance sheet and it corrects itself. Could be pretty serious, depending on the magnitude of the error. Okay, anyone with questions about inventory errors? So obviously a big deal. We want to be as careful as we can. We may have, depending on what happens, if we're using a perpetual inventory system, remember that physical inventory serves as a check. So we're going to compare what the physical inventory showed, what did we actually count to what did our records say we should have? And if we see glaring errors, we're probably going to look at that. Why are these two numbers so different? We're going to have an opportunity to try to fix the error in advance because that perpetual system serves as a check for us. System says we should have 8. We actually counted 4. Let's see if we can find those other 4, or it might serve to point out that we have an inventory shrinkage problem. Maybe we have a problem with a particular product being stolen, or even a particular product going bad and being thrown out, and maybe we need to rectify that, put some controls or some safeguards in place to protect the inventory of the company. Our next chapter, by the way, is on cash and internal controls, and we'll be talking more about what I mean when I say put some controls in place to try to prevent that from happening. So we call those internal controls. Questions? Anybody? You guys are really quiet today. All right, let's move on then. If there aren't any questions, we'll move on to our final exercise for this chapter. So starting in chapter 4, when we looked at the current ratio and working capital, and each chapter, we will be, almost every chapter, if not every chapter, we'll be looking at how do we use the information that we learned about in this chapter to help a company or help a decision maker make decisions about our company. And so since this chapter was all about inventory, our final exercise for this chapter is how do we use the inventory information to learn something more about our company, about the management or the running of our company. So inventory has a special concern for us because that's the product that we are selling to our customers. We said the focus this semester is really on merchandising companies. And so how can you sell product to your customer if you don't have it? Managing the appropriate level of inventory is really more of an art than a science, although there is a lot of statistical analysis that can go into that as well. How do we know, for example, that in March, we might need to have more eggs on hand in our store than we do in February or in April, depending on the timing of Easter. So Easter corresponds, or just before Easter corresponds with a spike in egg sales because all sorts of households, families are buying extra eggs to hard boil and dye and hide for their kids or whatever. And so there's a lot of unique twists like that a company, if you're a grocery store, you need to be aware of seasonal demand for products, demand for certain products going up around the Super Bowl and other, hot dogs around the 4th of July or whatever. So you might be thinking, well, then why don't you just stock extra? Well, we want to make sure that we have enough product, whatever the product is that we're selling. We want to have enough of it to meet demand, but we don't want a lot of excess products sitting around for a few different reasons. One, because we have to buy that product. We have to pay our suppliers for that product. So the concept of the financing period or the cash gap, we talked about operating cycle in an earlier chapter, maybe chapter 5, last chapter. The operating cycle is how long from start to finish, we buy the product, we pay our suppliers, we sell the product, we collect from our customers. That's the operating cycle. The financing period is generally a little bit shorter than that because it only goes from the time that we pay our suppliers until we collect from our customers. That's called the financing period or the cash gap. The longer we hold on to that inventory, before we sell it, the longer we have paid our suppliers and we don't have that money to use to buy more inventory, to pay our workers, to pay our taxes, or whatever other cash needs we might have for our company. So we're concerned about that, having a cash outlay longer than necessary. We're also concerned about things like inventory shrinkage. So we don't want to have the inventory sitting around and have it go bad or go out of style or get damaged. Beyond all of that, if we have the inventory, we have to have a place to store it. And so we have what are called inventory carrying costs. We might have a warehouse that's dedicated to storing that inventory, and we have employees in that warehouse whose wages we are paying to keep track of that. Maybe security, maybe someone to drive the forklift around to move the product. All of that adds cost to the running of our business. So ideally, we want the inventory coming in the door just as our customers want to buy it. We don't want to run out of inventory, but we don't want to have so much that we're carrying all this excess cost that does not contribute to the bottom line. And so what we're going to be looking at in this final exercise is two related measures: inventory turnover, and you can see the calculation there at the bottom of the screen, cost of goods sold divided by average inventory. Average inventory is going to be the straight or arithmetic average of the beginning and ending inventory. We simply add them together and divide by 2. Cost of goods sold comes from the income statement. Average inventory comes from the balance sheet. The second measure we're going to calculate is days sales in inventory. And I will show you their calculation, but I'm also going to tell you that's not how I'm going to calculate it. So you may or may not want to make a note of that formula for days sales and inventory. I'm going to give you one that's easier, since we're going to calculate inventory turnover first, because they're related. So let's go to our exercise. Final exercise for this chapter. Financial statement data for years ending December 31st for Tango Company follow. So we have 2017, 2016 side by side. We're first asked to calculate the inventory turnover, but I just asked you to make a note of that formula. So it is cost of goods sold for 2017. That would be $3,864,000 divided by the average inventory. So I explained that to find the average inventory, we're going to add the beginning and the ending inventory and divide by 2. Make sure that you put grouping symbols, parentheses, brackets, if you're plugging that into your calculator, to keep that whole denominator together. God bless you. So add the beginning and ending together, then divide by 2, and then divide that result into the cost of goods sold. So the average of 770 and 840 divided into cost of goods sold. I got an inventory of turnover of 4.8. Anyone need me to go over that calculation again, or you're all good? If you got that, go ahead and do the 2016 calculation as well. So I told you, when you're looking at any kind of financial statement analysis like this, we have to know whether a higher number is better or a lower number is better. In this case, inventory turnover being higher is better. It means that they're selling their inventory more quickly. So in 2017, they were selling, on average, they were selling through their entire inventory 4.8 times per year. Inventory turnover is expressed as a number of times. And in 2016, they were selling through their inventory about 5.3 times per year. So 2016 is a faster turnover. And as I just finished explaining, faster is better, right up to the point where it means that we're selling out of inventory. We don't have anything to sell to our customers. We want to sell as quickly as possible without losing sales. Any questions about that? I told you I was going to give you an easier way of calculating number of days sales in inventory, easier than what the book uses. If I can get my annotate function up, I'm going to give you the formula here. So days sales in inventory. Here's my easier calculation. 365 divided by inventory turnover. So in the PowerPoint, in the textbook, they have you calculate the average daily inventory. And then do the final calculation. That's unnecessary work. We already know the inventory turnover. For 2017, it's 4.8. So we just take 365 days in a year. If we're turning over our inventory 4.8 times, and it says round to 1 decimal place. Oops. And so that would be about every 76 days. They're selling through their inventory on average about every 76 days. Does that mean every single thing in their inventory sells after 76 days? No. Again, back to that grocery store example, things like dairy and produce are going to sell much more quickly than 76 days, but things like canned goods, non-perishable food items are going to take longer in general. I also don't want you to think that grocery stores have turnover of 4.8 times per year. The average grocery store turnover is like 13 times a year, less than a month. Go ahead and, if you haven't already, do the calculation for 2016, round to 1 decimal place. And so just like I talked about with the inventory turnover, higher is better. Number of days sales in inventory, lower is better. We want to be sitting on less inventory. Unless it means we're losing sales because we don't have enough inventory to satisfy demand. And so with the changes from 2016 to 17, was that good or bad? Unfavorable. Unfavorable. Remember, we talked about when we introduced our first calculations of working capital and current ratio, that we need to have something to use as a comparison. Here we're comparing ourselves to ourselves. How are we doing compared to last year? Or maybe we put 3 or 4 or 5 years in a row and see what's the trend looking like. One more thing I want to talk about, but we're done with this chapter. But I do, because we have a little bit of time left here, about 10 minutes, I want to use that time wisely and talk about one other thing. Any questions though from chapter 6 before we put this away for the day? Okay. So one other thing I want to look at. As you know, this is the end. This is the end of our work for, oops, sorry. This is the end of our work for exam 2. And so I want to remind you about the practice set and talk a little bit about the exam. We have covered everything that's on the practice set. Excuse me, everything that's on the exam, chapters 4, 5, and 6. There are no specific questions that come from chapters 1, 2, and 3. However, we know that was the foundational information. So you have to be able to use that knowledge from those earlier chapters to apply in these chapters. You can see there are a few more exercises here in the practice set than there were for exam 1. So in our review session tomorrow, we may not be able to get through all of these. If you're planning to attend the review session, I would encourage you to look at these in advance and let me know if there are specific, not in it, you don't need to let me know in advance. But when we start the review session, it would be helpful if I know from the people who are there. I'd like to look at exercise 1, 7, and 14. Those are the ones that I thought were, you need a little more review. The exam officially opens on Thursday. But as far as I'm concerned, if you have finished all of the work through chapter 6, including the problems for chapter 6, you're welcome to take the exam whenever you are ready. The exam needs to be taken before the end of the day on Sunday. Remember, we don't have class on Tuesday. So let's take a look at the exam. So this exam has 25 questions on it. You have the same 3 hours to take the exam if you don't have accommodations in place. You have the same 3 hours that you have for every exam. 25 questions, just like with the first exam and with all the other exams. There is a mix of multiple choice and exercises. The exercises are going to be similar to what we've done in class, as well as what's in the practice set. Just like with exam 1, the practice set is optional, but recommended. If you have questions from the practice set, if you don't make that review session, or if it's a question maybe we don't get to in the review session, you are welcome to schedule time with me. If you don't see any free hours on my office hours schedule, you can ask for a different appointment. Just let me know what works for you. If I can, I will be happy to accommodate that. So remember, when you're taking the exam, you want to open your book first. If you don't open the book first, it does not like that and won't let you open. Once you open the exam, it may not let you open the book after you've opened the exam. As long as you open the exam first, or excuse me, as long as you open the book first, it's fine. I also wanted to remind you, because the chapter 6, we didn't, at the beginning of class today, we didn't do our normal what's due when. It'll be in the announcement, of course. But for chapter 6, there's one problem that is required, that is, it's part of your grade, but there are two extra credit problems. And the reason there are 3 is because we have 3 different methods, LIFO, FIFO, and average cost. There wasn't a problem that incorporated all 3 of those, but I really want you to practice with all 3 of those. So I included a couple extra credit problems. It doesn't negatively impact your grade if you choose not to do those, but if you do them, even if you don't get 100% on them, everything you do on those will contribute toward a positive increase in your grade. So I would encourage you to do those as well before you take the exam. So any questions, please stop with the books. Class has 5 more minutes. It's not polite to be making so much noise with your bags while I'm still talking. Thank you. Are there any questions? Anything else you want to talk about from the chapters that are on the exam, or anything else? All right. Thank you for being here, and I will see you all on Thursday. On Thursday, we will be starting chapter 7, which is not on the exam.